Good afternoon, everyone. My name is Cody Carbone. I am the policy director here at the Chamber. As part of my role, I have the distinct pleasure of leading our tax working group and our accounting initiative, two policy areas that I think everyone in this room can agree on are essential when it comes to the success and widespread adoption of blockchain technology and digital assets. I am ecstatic to introduce our next panel. We have a great panel of regulatory experts and industry experts that are going to discuss the need for clarity and guidance in this space. So please join me in welcoming Roger Brown, Global Head of Tax Strategy at Chainalysis, and our panel. Thank you very much.
What a great panel and a great day to be here. I want to welcome some friends and colleagues and really look forward to spending the next 49 minutes with you. Rob Massey, we have here, he's a partner at Deloitte, global tax leader, blockchain and digital assets. We have Aaron Jacob, head of accounting solutions at TaxBit and former FASB staff. We have Fred Cannon, immediately raising his hand there, a board member of FASB. And we have Jessica Reif Kaplan, VP Tax Counsel of Fidelity. I'm Roger Brown, Global Head of Tax Strategy. We're going to cover four areas. The first is the current state of tax and accounting issues faced by businesses getting into crypto. The second will be policies informing tax and accounting rulemaking. The third will be operational issues for businesses. And the fourth will be what's at stake for not engaging in policymaking. Rob, we'll start off with you, setting the table. You've been involved in crypto tax issues for over a decade. What are you seeing today in terms of popular topics among your clients, and what are the best practices?
Yeah, we have so many trends right now, and it really cuts across a lot of different segments of the ecosystem. Let me outline a few, and you guys will keep me honest here. I think first and foremost, a ton of corporates engaging, large-scale enterprise, not just small companies, but large brands engaging. They're evaluating crypto as a form of payment, taking it from customers, using it to pay in employees or key vendors, right? And we get into complexities around, what does it look to transact with something that's not exactly money, but it feels like money? And what does that look like from a reporting, from an accounting perspective? How do you deal with valuation? How do you deal with withheld payroll taxes when there's only a few states that take it as a form of payment? So lots at the enterprise level. We're seeing funds, both crypto-native funds and large-scale funds looking at deploying crypto assets from an investment standpoint, which is all fine and good, except that these are not traditional securities and commodities. What do you do from an ECI perspective? What do you do with unique forms of yield when you're talking about staking, when you're talking about borrowing, deploying into DeFi? And so that's causing us to look really deeply at how to structure funds, how to look at those types of income. We see it throughout, more and more token and protocol issuers coming to life. Not a lot of clarity offered in the tax rules right now, and so every time we come into these unique transactions, we're like, okay, what do we do with this? What are the analogies that we can make? One of the areas of clarity that we do have, though, is the infrastructure bill. And so now we have a definition of digital assets, which is great. We have info reporting, which is now law, and so we're looking at how to deal with that. But it's pretty wild times as we look to apply these new rules and hope for some clarity soon.
Got it. Great framework. Jessica, how are you gearing up for the Infrastructure Act, the reporting requirements that Rob just mentioned? And being VP of Tax for a global business, in what ways will it make your life easier, the Infrastructure Act? In what ways will it make it more difficult?
Yeah, so I think I'll start by saying this infrastructure bill, as Rob said, was welcome, that we now have some guidance. I think the industry was really asking for this for a long time, and so it's really nice to have some clarity on those rules and just the general framework to start with. But clearly it's not done, right? We had this set of rules that came out, but we still don't have any idea about how we're really going to implement those, what that's going to look like. We're still waiting on regulations and some rules. And as an industry, I think you see folks getting a little bit nervous with the clock ticking and time coming, and it'd be nice to have that further package so we can really start doing implementation. That's when the work really starts too, Roger. This is nothing that you can take off the shelf and put it to work. You really have to build for this. This is a completely different asset class, and what happens to that asset class is different than your traditional securities, and so you have to really build from scratch. One thing I would highlight in addition with this is, as noted, we have some clarity now, we have some rules, but these rules are limited. These speak to gains on this asset and don't really speak to any of the other things that could be reported, that could be reportable events. And I think that's where things are still very tricky for the industry, where you have different things, some of which Rob already mentioned. So for instance, staking is something we hear about a lot, and staking is something that actually has gotten a fair amount of tax press and regular press as to what is it and what's happening there? What's the timing of that event? What's the source of that event? And this is something that I think the industry would love to have an answer on, because if we're building a reporting system, if folks are building reporting systems, this is something else that might need to tap into that, and it's helpful to build all of that at once. There's also lending, which I think Rob also mentioned in his intro, another place where there's seen a lot of press, there's a lot of questions. Is that a non-recognition event? Is it actually a recognition event? You know, what do you do here? What reporting is required? And so again, all of these are larger questions that we see from a tax perspective of what's happening and what is it, but I mention them because they tap into reporting and they tap into what kind of systems need to be built to account for that and how do you build for that. The final thing I'll note about this that I think is really interesting is we've been hearing rumblings, and I think the infrastructure bill sort of started going in this direction, where we traditionally think of assets like this that you might invest in as a security or a commodity. And it looks like there's a third category being created here of a digital asset. And if that's the case, then how does this look like for everything else that we do where we're making investments? Is this now a new category? I come from Fidelity. Mutual funds are obviously a big part of our business. What is this, right, to a mutual fund? And so sort of those are the questions that are really interesting that still need to be answered. Infrastructure bill was a really good first step, but there's still a lot left that we're all hoping to understand.
Yeah. I think your point about is very powerful around the need for clarity, because the Infrastructure Act put in rules for gains, but as you say, people earn more than gain. And instead of taking away issues around information reporting, we basically have the entire infrastructure, no pun intended for Infrastructure Act, we have the entire reporting infrastructure still in place. So where you have ordinary income and other kinds of income, they're not gain, and you only get gain from selling an asset. So staking, mining, airdrops, these things do not result in gain. So therefore, query, what are the information reporting responsibilities? Yeah, so exactly. your point is well placed.
The timing, real quick, the timing of this is interesting, right? Because we've been talking about clarity for information reporting since prior to when there were staking protocols in existence, right? So let's just stew on that for a minute. It took so long just to ground down to one topic that the industry completely went beyond that which was imagined when we first started talking about it. So that pace is unique to this industry, and that just keeps all of us really in check.
Fantastic. And we won't get into the international issues like source and those sorts of things. That'd be too complex. Aaron, TaxBit is a tax and accounting platform that in recent years has flexed into the institutional and government space. Can you talk about your engagement in these sectors, including with regard to the Infrastructure Act?
Yeah, it's been really fascinating to see the pace of adoption in the institutional space. You know, we started out in consumer retail, and now there's so much activity in the enterprise space, both on the tax and the accounting side, and now in the public sector space as well. And it's a fascinating time that we live in. And we live at this fascinating intersection of take the regulatory framework as it's evolving and ever evolving and changing, and operationalize that. Like, where does the rubber really hit the road? And providing solutions to companies that enable them to scale while maintaining compliance as that regulatory landscape continues to take shape. What I think is interesting with the infrastructure bill is, you know, we're waiting for the regs to hit. We'll see what that looks like. But companies, they need to have solutions in place that will enable them to stay in compliance, whether that's additional form generation, whether it's transfer statement tracking, whether it's just cost basis tracking and tracking the various forms of gains and losses and income that you might follow. More recently, while there's a lot of activity on the tax side and anxious anticipation for the regs to hit, we've also seen a lot more activity as we've pulled out of tax season, starting to focus on the financial reporting side of things. And companies also place heavy emphasis on their accounting, the systems that are in place to help them get financial reporting for digital assets right. It's a high-stakes game. There's little room for error, and having the tools and ability to scale, rest comfortably at night, knowing that you're building on a solid foundation is really critical.
Fantastic. And as people were doing this, are there certain pain points that people are dealing with as it comes to putting digital assets on their books?
Yeah, when I think about pain points, we hear this from our clients and from the market on a daily basis. I kind of categorize pain points, and I'd be curious to hear others' perspectives on this, in maybe 3 different groups. The first category is the data side of things, data aggregation, data ingestion. We live in a world where companies are pulling from many different sources. There's disparate data sources. There's oftentimes no normalization of data across these different sources. And the need to be able to aggregate together, have everything under a single roof where you've got kind of a one-stop shop to see your activity and then action on that data in a normalized fashion is really challenging, and it's an important challenge to have a solution for. Maybe the second category of challenge that I would describe is the calculations behind this, making sure that you're able to track at the lot level cost basis and book value and fair value and all these data points that are necessary to get the tax and accounting correct. And then when you layer on top of that, I know we'll get more into the accounting side, impairment calculations, and some of the nuances that the guidance requires, that calculation engine becomes very important to place emphasis on and to find a solution for. And then the last part is being able to then take that wealth of data from transactions and calculations and put it into reports that can be easily ingested and fed into your period end process. At the end of the day, this has to be operational, and the operations need to be most efficient so that companies are able to close their books on time and get done what they have to get done, and do that in a streamlined fashion. So those are kind of the pain points that I see most broadly in the market.
Got it. Speaking of pain, you can't not touch on, think of the long-lived intangible characterization and really the accounting pain that some institutions have had. So I'm sorry to use pain and Fred, your name, in the same sentence. Apologies. But we've talked about accounting. It seems like you started with a long-lived intangible label with crypto from an accounting perspective, and that's not unique to the United States. I would say the German phrase, but I don't have enough time remaining in the panel to fully articulate it. But in any event, can you describe what it means for the practical implications of that treatment, and what types of analogies are you considering giving the criticism of this treatment?
Well, I guess ouch is the first term when I think. And I do have to do a disclaimer. I'm just one of the 7 FASB board members, and I speak for myself, not FASB, as we can talk about. We go through a very extensive due diligence process before we make decisions, which we can talk about that. But yeah, so essentially what's happened is US GAAP didn't foresee digital assets. And so as a result, as we have digital assets become prevalent throughout the economy, the question is, where do they fall? And essentially where they fall is because there's not another place and they aren't a tangible physical asset, they fall as an indefinite-lived intangible asset. And that's a challenge for many corporates, which Rob was discussing, because an indefinite-lived intangible, for those of you who don't know, it's put on your books, on your balance sheet at cost, and then essentially it can't get written up for an increase in value, but it can get written down for a decline in value. And that's called the impairment model. And so essentially, it goes on at cost. It can only get impaired. And so it can only go down in value, not up, and given the volatility that we have. And that impairment goes through income. The underlying challenge of the impairment model is it isn't just a measurement at the end of the quarter. It's the measurement at potentially the lowest price seen in an active market during the quarter. So you can see that adds another complexity when you're starting to talk about the impairment model. FASB recently decided to address this issue on May 11th. We put it on our technical agenda, which means we're going to potentially have rulemaking on this. I would say the majority of the board doesn't think that the current model really reflects the underlying economics of what's going on.
Got it. So it's interesting. I mean, we can start transitioning to our next really series of questions around policies informing tax and accounting treatment. We did have Erica Ninehouse of the Office of Tax Policy, senior counsel there, as part of this panel, but due to travel issues coming back from Europe, she was unable to attend. And there were really, we were going to talk about really 4 of the proposals in the Biden administration's Green Book. The first was around Section 475. That deals with the mark-to-market of assets. And in effect, this is neither neutral, well, it's neither negative nor positive, it is neutral, that basically seemingly reflects a fair value of accounting for traders and dealers in securities and commodities, and it was going to extend that to digital assets. And the second proposal was, and I'll pause here for a bit to turn to you, Jessica, was around lending, where people often seek to monetize their assets by lending them out. And digital assets are no exception. And here, there was effectively a safe harbor, which it builds on an existing, for the Code for Securities, for being able to lend out digital assets, similar to securities, and interestingly, the current statute doesn't allow commodities, but just securities, allow for non-recognition of gain or loss, assuming that one doesn't really forego the opportunity for profits. And this would have been very relevant in real life, where most recently in the press was reported that somebody had a Bored Ape, they lent it out, the person who borrowed it received an airdrop of ape token, and then they returned it at the end of the term to the original lender. Now we don't know the person, but presumably they didn't recognize gain and loss. But this kind of thing would have been very relevant because you can't do that sort of thing and have the borrower receive, in effect, the entitlement without having to make an economic payment over. So in your practice, I'd welcome, how often do you see that given Fidelity's business in digital assets?
Yeah, well, I'll actually take a step back even and talk a little more. I'm not sure how much folks even appreciate this, and you touched on it. There have been rules in place for a very long time that speak specifically to lending of securities. And even that is fairly limited. The lending of securities is limited to interests in C corporations. So it's not even any publicly listed security that can be loaned and treated as a loan, because in part, these income events too get more complicated when you're dealing with anything else. So what was really interesting about the Green Book as well is that it talked about digital assets, and it took into account the fact that this was going to be a change, but it also talked about things like publicly traded partnerships and those kinds of securities that to date have been excluded from that rule, and you would have to rely on general principles or other things to get there, and really broadening the way this rule would work, and giving the Treasury Authority to write some rules on this and broaden its application. So I think it's important to note there was also just some history here about how complicated it's been, and those kinds of income events have been complicated on those other securities historically as well. If there were guidance issued here, this is a wonderful thing to read, right? And if there were final guidance issued here, it would provide a lot of clarity for folks when they're doing those loans, both for the non-recognition events like you were talking about, and also for those income events, because there's not consistency in the market even about what those, so far as I understand, what those agreements look like for the loans. Whereas in the securities market, it's very standardized. There's a lot of rules about how it is, and they really look the same across the board. And so having that, and one of the things taken into account is those income events and what needs to be done. Having all that taken into account and standardized would really be beneficial to investors, to customers, to clients, to folks who are trying to do these transactions to know what to expect and what's coming.
Sure. I would imagine it adds more liquidity to the marketplace. So we were talking about the Green Book. And one of the provisions relates to information reporting for brokers. Here, it really expands, quite frankly, the current framework where the Infrastructure Act deals with reporting by brokers, as well as effectively exchanges, as well as their foreign subsidiaries, and the reporting to the U.S. people. The Green Book, in effect, leans into the space, in effect, converse to FATCA, where if you have a foreigner, say someone from France who's now a U.S. customer of an exchange, you'll be reporting on them as well as any passive entity that they're investing in. So there, historically, the information rules have not applied to that. And now, in effect, domestic ones. And now, in effect, we are leaning into the FATCA/CRS space for digital assets. The OECD has put out a framework where effectively it allows for the swapping of information. So if I open up an exchange in, say, KuCoin in Hong Kong, now all of a sudden that information will flow in, so the IRS has a more complete picture. So wherever somebody is trading, there will be that information. So is anybody thinking about that aspect in any of your practice? Or is that something that they're not ready for the domestic rules, and who knows what this OECD framework is going to be.
Yeah, I mean, I think everybody's thinking about it, and it's we've got rules in play that are analogous to rules of other types of transactions. But what's different about this space is that the role of the different parties varies wildly, and so what we find clients doing. While we're waiting on clarity, you got to get ready for it, right? Because we have, transactions on or after Jan 1, right? We need to be tracking those. So how do we get ready for it? The first step is evaluating where you fit in the transaction flow, right? What's the thing first? What are we talking about here? We have the definition of digital assets, so that's clear. But the role of each party in the transaction flow is critical, right? Are you facilitating the transactions? Are you a counterparty? Are you the one merely providing software, right? And all this is very different because we've automated so much through the use of smart contracts in this space that it really calls into question, what is the transaction flow? And importantly, what is my role in that transaction flow? This is where people just have to pause and say, what is represented in the technology? What is represented in legalese? Those two things have to match, right? And the difference with smart contracts, the difference with blockchain is that we have extraordinary transparency around the transaction flow, importantly around financial products and around the systems that are facilitating the transfers. So we have a different level of transparency and depth on the transaction. It's not just that which is represented in legalese or in a disclaimer. It's that which is actually happening. We can all see it. And that means that we're digging down even deeper to make sure this works. Maybe I can go back a second on the lending piece as well. Similarly, we're talking about the clarity that's offered, just a proposal, right, with the Green Book. But this is leg one of the transaction, which we're talking about, right? This is lender to borrower, saying if we follow the analogies of SEC lending and I retain the benefits and burdens of ownership, then I shouldn't have a recognition event. Great. By the way, they also threw in a little kicker that says term loans are now in, both for SEC lending and crypto, which was kind of cool, I thought. But what's not addressed is the rehypothecation end, right? And there's some interesting banter going around because these aren't securities. The way it's constructed is we're not redefining crypto as a security. So does that mean that there can be a level of rehypothecation on the borrower side, right? That's less of a tax question, but the economics that drive SEC lending and that should drive crypto lending means that there's a level of rehypothecation on leg 2. That was not really clarified, and so I think we're waiting for the rest of the regulatory framework to shake out. This is critical for the industry to engage.
Yeah, and I think this goes back to some of the comments making earlier about investment products and what's available, because what you're talking about really is an investment product as well and what could be happening on the back end with it. And it's putting all of those pieces together that allow you to build something.
Got it. So we've touched on classifying crypto, and this SEC lending statute, proposed, if it does find its way to a statute, the SEC lending proposal for digital assets, the information reporting for digital assets, they're adopting a new framework, a new word, and people historically didn't have that luxury of pointing to a word and saying, is my thing a digital asset? They were struggling, what is it? And we have phrases we have the commodity notion, and people have had to struggle, is crypto a commodity? And if so, are all crypto assets a commodity or only some? These are the sorts of things. Before we go into tax, maybe Fred, I'll ask you given that there's different uses of digital assets, we just can't think about Bitcoin, which does nothing but be Bitcoin, but there are other things business assets that do things, that perform a business function. So as you're writing rules, are you thinking about NFTs, utility tokens, payment tokens, representations of fiat, redeemable into fiat? Are you thinking about all these different flavors? I almost feel like it's a Baskin Robbins store from the 1970s.
Right. So the challenge that we have, I think, like you can imagine, is that if we start looking at every possible use for digital assets today and in the future, we might not address the issue that we've been asked to address, and that is the current valuation model and whether that works. So I think the short answer is yes, we are looking at various uses. Yes, whatever we do, we want it to be informed about the future and how things develop. But we don't want to start going down every direction in terms of what would be the right accounting for each different use, because I think we would, in my view, one board member, we would miss the picture that today's accounting, in my view, again, doesn't reflect the economics. If we can get today's accounting to better reflect non-securities, digital assets that aren't considered securities, that are under this impairment, this model, would fair value improve that? We need to think about all the ramifications and make sure that we allow flexibility over time, but I don't think we can anticipate every possible use. The other issue, which I think Aaron, who worked for us for a while, accounting is challenged when we start to use intent as a basis for accounting rules. It's not saying that we can't use intent, but when we do, it starts to get a little bit difficult. So the short answer is yes, we are going to, but we also are very focused on achievability and improvement for users, financial statement users, who is our primary constituency.
That's important. Aaron, any thoughts on that?
Yeah, first off, we're grateful for the work of the FASB. You know, having been there, I have some understanding of the diligence that goes into it and the process behind it, and look forward to engaging with the FASB. And I know that the board and the staff there, they are anxious to engage with any stakeholder community. So encourage people to get involved in that process. And we look forward to being a resource and helping out and presenting also the views of our clients in that process as well. I think there are a couple of interesting things to note here. One, the industry is clamoring and kind of begging for accounting that is a better reflection of economic reality. Fred, you mentioned that, and right now there is a pretty substantial mismatch. And let me give an example. When you're accounting for digital assets as assets on your balance sheet, you follow this impairment model. So I hold them on my balance sheet at the lower of cost or impaired value. So if there's a pullback in prices, I have to write that asset down and book an expense on my income statement to reflect a loss. Contrast that with the liability side of the balance sheet, where if I'm holding liabilities, digital assets as liabilities, I hold those at fair value. So if there's a decline, then my liability declines. If there's an appreciating environment, then that liability goes up. So it results in a significant mismatch, particularly in times of appreciating environments, where you could have assets that were written down to their lowest point during times of depreciation, and then liabilities that are written up to fair value during times of appreciation, even though it's the same asset that's being reflected on both sides of the balance sheet. So it creates a ginormous gap in equities, no pun there. But it creates an issue for challenge for companies to explain to their stakeholders and their investors. I'd say maybe two other things. I loved how the staff teed up the issue when it was brought to you a couple of weeks back, where they basically said, we're considering three things: the pervasiveness of the issue, and acknowledge that, given the rapid pace of adoption, this is a pervasive issue. They also acknowledge that it can be scoped. Like, there's the ability to kind of narrowly define and target the greatest needs of the market. And then finally, there's a feasible solution in place. And I think that's important for folks to understand, and that is part of what led to the board, I'm assuming, vote to add that to the technical agenda. The last thing that I'd note on this is just that process matters. I think we have a very interesting, juxtaposition for what the FASB is doing and the diligence there. And recently we had the SEC come out with SAB 121, which kind of surprised a lot of players in the market. And the process matters, and being able to get input from constituents, from stakeholders, from the market in general, consume that input, it helps us get to good answers at the end of the day.
Got it.
And just to level set, that is a very good, because Aaron did a great job laying out the criteria that we use, but just to level set the process from here is, an issue has to make our technical agenda before we can actually set a standard. So that's the first step. The second thing, as Aaron's saying, is we have to do a lot of due diligence to make sure the staff understands these issues. And then we have to deliberate a number of issues that will come to the board. Just applying fair value is complex for this asset because there's certain issues in terms, some narrow accounting issues to apply that don't necessarily apply. So we have to do that. I think we had a meeting with the Digital Chamber, I think a week or so ago, and I think our staff was saying, kind of best case, we would get what's called an exposure draft out by the end of the year or early next year. An exposure draft is our process where we draft a new standard, but then we go through a process where we give a 30, 60, 90-day comment period. Then we deliberate before we put out a final standard. So just to kind of level set, that this isn't something that FASB is going to be able to turn on a dime and get out in the next month or quarter.
Got it. And to continue on with the policy part of our panel here, are there certain policies with regard to asset classification that could help spur growth? And I'll throw it perhaps to Jessica and you to Rob to think about this, of the different characterizations.
I saw you about to talk, so turn it over to you to start.
Well, I want to round out quickly. I mean, we're talking a lot about some gap treatment here. Remember that tax does not necessarily follow gap, and so it's frequent for us to have a difference. So when we're talking about adjusting assets on the balance sheet or even use of in the business, we probably will have a different treatment for tax purposes, right? Because until you're actually using or disposing that digital asset, we may not have a recognition event for tax purposes. And then you have to ask, well, which one did I use? And so accounting methods in this space are pretty important. We talk about specific ID a lot, and whether or not you actually need to segregate, that answer may change, maybe, because you are with a custodian or you self-custody, and what does specific ID mean to secure that method? Maybe a little bit of evolution that we're expecting with the regulations in the infrastructure bill, because we've defined covered securities. And without specific ID, you may be bound by FIFO. But the important thing to remember is that even though we may be adjusting gap in the near term, thank you, Fred, then that would be, and which is, I think, welcome to many, that doesn't necessarily change the tax answer. We're still going to be living in this world. Then you bring into life deferred taxes, which is relevant to those who have financial statements.
So I'll take it back to policy, I guess, to your original question. I think the basic thing that the industry would ask for on the policy front is really clarity. I mean, at the end of the day, that is the most important piece here. Is we've talked about sort of all these open issues, right? What is it? How do you treat it? Clarity on all these would be beneficial, and I think they'll be particularly beneficial to the folks who are making these investments. They know what they're getting, and they know when they're getting it. If we go back to reporting, like we were talking about at the beginning, and staking, you'll find across the industry that there are different folks taking different positions on what that is. And so some people will be getting a 1099 miscellaneous in the mail in January, reporting some income from staking, others will not. And that is likely confusing to people, and they don't know what to choose and why they're getting that. And so clarity, I think, is really helpful for folks as this industry evolves, and then they can know what to expect, and then folks like us can know what to build.
Well, your example is very real, because I actually received 1099 misses for some places where I was staking, and no 1099 misses for other places I was staking. Being a tax lawyer, it was easy for me to report everything, but other people who are not tax lawyers, who are not so blessed, would struggle with what to do.
Right, but we have to remember, like, we do this all day, every day. We know that we live in a self-reporting jurisdiction. We know that there's transactions we need to report. Most of the humans in the U.S. don't think to put something on their tax return unless they get a Form 1099.
Absolutely.
And so I think we have to remember that as legislators, right? Those who are present, like, and people are asking for this, right? We need clarity so that everybody is on par, because we talk about enforcement a lot on this stage today. I think if you're going to go after enforcement, you also have to give people the tools to know what we're talking about, because unless you really study this stuff, you're probably not going to get it right. And by the way, it's hard, right? This is really complicated. It's changing every day. So I think that there's a level of excitement around the clarity coming to bear. Yes, it's hard. Yes, it's complicated, but it's really what's needed at this point. We've reached that level of scale.
Yeah, and I would even to Aaron's point, to what his company does, to complexity, because if I'm staking through a service and they give me a 1099 miss, or then if I don't get one, what's my basis in what I was staking? Do I use my average cost where I get an annual 1099 miss? But my rewards were daily, and do I do a daily average, do a month-end average, and what did they use? So if you don't get it, it makes me nervous. Now, will the IRS agree with whatever I put? If I'm going to put what I received on a 1099 miss, okay, that's my basis, whatever I earned, putting issues aside with regard to how I allocate between my earnings and my original basis. But then if I don't get it, how do I determine that and use your product, et cetera? So again, complication. Let's flex into operational issues, because this is something that has, I think, received a lot of press recently, where the SEC advised in SAB 121 that crypto assets on the balance sheet of a custodian basically should be reflected as a gross asset and a gross liability, grossing it up. Fred, I'd welcome any reaction you'd have on SAB 121.
Well, I'll have to really put a disclaimer on this one. I'm not a part of the SEC. It is important to recognize that a staff accounting bulletin is authoritative accounting. So if the SEC puts this out, it is authoritative and has to be followed. So I think basically, for those of you who aren't aware, what it said was they believe there's unique risks to digital assets, and therefore a liability for those assets has to be recognized. And that liability would be put on as a fair value as a result, and then there would be an offsetting asset equal to that liability, a fair value, which essentially expands the balance sheet. Now, this is unlike most, not necessarily all, but most custodial assets and custodial financial assets that are not put on the balance sheet of entities that manage that. This is especially has implications, especially for the regulated financial service sector because of regulatory ratios relative to the size of the balance sheet.
I thought it was interesting because as justification, they pointed to certain legal risks, operational risks, and technical risks. What I haven't done is go back and see are there other asset classes that have one or more of these risks where SEC registrants were required to report things gross. I think that would be interesting, and something people in the crypto community complain, don't treat us differently, treat us like traditional financial assets, and this is an instance where we're not. And again, are there instances where there are assets that have unique risks, and are they similarly grossed up?
I think there are maybe a couple of interesting points to make here. One, it gets back to process. The process was interesting here. There's a lot of good people that are doing a lot of good work to seek clarification around some of the nuanced questions that SAB 121 brought up, including what is the intended scope of this. As I work with companies on this, there are maybe three kind of key takeaways and questions that we see in the market. One is, how do you value certain of these assets? You know, particularly when you think about the long-tailed, thinly traded assets, if we're grossing up our balance sheets to reflect fair value measurements, how do you value some of those assets? I think there's a challenge there. Second potential challenge is the double counting of assets. So if I have a platform and I am safeguarding customer assets on my platform, I put that on my balance sheet as a liability and an asset. But then if I outsource some of those custodial services to other providers, they also gross up their balance sheet. So you have this potential issue of duplicating the same digital assets on multiple balance sheets across the ecosystem. And then maybe a final point on this is accounting teams are now faced with the challenge of applying multiple accounting models to the same asset. You know, where I might fall under intangible asset accounting if I meet certain criteria, and then if I meet other certain criteria, all of a sudden I fit under SAB 121 and use a fair value model. So there's some interesting questions that are rising, and a lot of good people doing good work seeking clarification for folks.
Yeah, there are real operational challenges. And Jessica, what kind of operational challenges are you facing in your business?
Well, I think I'll just speak for the industry on this one, which is just going back to info reporting. That's really the number one I think that folks are dealing with right now as they figure out how to do implementation for that. And I think that's where TaxBit plays a huge role as well in helping people figure out what are they solutioning for, how are they going to implement this, because it is a sea change. Fidelity, obviously, we are familiar with some of these rules in different contexts, right? But many others in this space are not. And so how are they going to handle this? How are they going to think about this? I think the industry would probably say that's the biggest operational challenge right now.
Yeah, personally, I find the operational aspects the most interesting because people can theorize about how one should treat it, but effectively, technology, reporting, the business is where the rubber meets the road. Rob, you are where the rubber meets the road. And in fact, if you were to get a tattoo, you should have that as a tattoo.
No tats yet.
No tats yet. That's
right.
So what are you seeing in your business where the rubber meets the road?
Yeah, I mean, we see collaboration among different competencies at a new level in this space because it's new for everybody, right? We're talking just among us about the differences between tax and GAAP. There's also a lot of differences in the way that Treasury may look at it. What about SEC reporting and counsel? And so when we have clients that take on these topics, the Zoom party becomes pretty full, right? And it's a representative of everybody throughout the organization internally, and frequently their advisors to back them up. And so it's a level of collaboration that's different because you can't assume that you know what they're doing in the department across the way, right? You knew forever what they did from the GAAP perspective on these kind of transactions. That doesn't happen anymore. We can't make those assumptions. So you have to say, okay, Fred, what are you doing from a GAAP perspective? All right, let me digest that for tax. We need to listen to one another at a different level so we don't have a mistake. And that collaboration happens as you're iterating through a new product. It happens through a close cycle. It comes through reporting. So that collaboration happens at a very different level. And I think the leaders that really are good at building this cross-functional community and allowing a dialogue, you're going to bring a different level of grace as you're adopting these new processes. And it's not just the advisors. It frequently comes to products, right? And there's two represented on the stage, right? A lot of people going to taxbid and Chainalysis saying, hey, can you help as well? Because there's stuff that we can't really wrestle with. And it may not be just one or two, but it may be multiple. And how do those tools fit together? How does that technology then integrate with the rest of our tools and technology when it comes through a closed process? So a lot out there, and it's worth it, right? People come to this conclusion over and over again. Difficult, challenging, doable in a collaborative sense. It's worth it. We're bringing new commercial activities to bear.
I'm glad you touched on, quite frankly, the interoperational aspects to this, because in all candor, and Jessica can speak to this best, there's no one solution on the shelf to say, oh, here's my panacea. I don't have that. Aaron doesn't have that. You don't have that. Fred, in his, as always, a standard setter, he doesn't have that because there's so many nuances. So you need to put together, on chain analytics, we'll use a company like Chainalysis. We want to do gain-loss calculation and have accounting. We'll use a company such as TaxBit. We need an advisor to put this all together and tell us how to implement these things. We're going to hire a company like Deloitte to come in and put this all together. We need travel rules, something we haven't mentioned to date, where different countries around the world for transfers between exchanges or private wallets is going to have reporting. That's another vertical we're going to have to hear. A KYC solution. So when someone comes on board, I can electronically onboard them and not have to have them talk to a human being. And that's an automated solution. All these different verticals need to come together in a harmonious way and have a consultant, like yourself, like Deloitte, come in and put it together, because Chainalysis alone can't do that. We're one of the blocks. You're one of the blocks. Everybody else, and companies like Jessica's is the beneficiary for that. That's really, in effect, how no one company has these solutions, and how do you make these disparate systems grow up and function together harmoniously so that when the domestic reporting rules come in, putting aside what current law is for these people reason they're generating 1099 misses, but for the 1099, whatever version is, people have suspicion of what it'll look like. How will those forms get generated, and what data, as of in Jan 1, will start feeding into that, and how the systems talk? I think that's a really important issue from an operational perspective. We've got a little less than 6 minutes, and our last really area of our panel is what's at stake for not engaging in these topics. So, Rob, let me start with you. What's at stake? And I don't mean that as a consensus mechanism.
I'll take it at two levels. I mean, as a firm, we saw clients in this space 10 years ago. And so we pride ourselves with helping, if something's important to a client, it's important to us. No rules, let's figure it out. Let's engage with regulators. And I think it's increasingly such that if we don't engage as an advisor, then our clients are going to find us useless pretty quickly, right? So if we have to engage, even in a space that has a lot of range and the right answer, carefully. We have to do this, otherwise we're going to be irrelevant very, very quickly. And we aren't expecting clarity anytime soon across a number of fronts. This means write it down, build your positions, make sure that you're ready if anything comes up, because you get asked that question, you better know what you thought at the time. So as an organization, there's a lot at stake. I think there's also a lot at stake as a nation, right? We're seeing a ton of innovation that is inspired with blockchain and digital assets from the US. And we're starting to see a lot of very respectful, kind tone toward the innovators and the entrepreneurs in the US. I think we need to keep that tone. I think it's really important to us because you can sort of live anywhere today, right? And so we need to make sure that the US keeps that innovative spirit and that we keep a respectful tone with the entrepreneurs. I think there's a lot at stake as a nation if we don't embrace it and take it thoughtfully and respectfully.
Got it. Jessica, what's at stake for not engaging?
I don't know if I can say it much better than Rob just did. As a nation, that's a big question too. I think it really is, I'm approaching this from a customer mindset where I'm thinking, what's at stake is people don't know what's going on, right? You talked about how you have knowledge of the tax rules, so you know what to do, but that's not the average American, right? And you have a lot of knowledge, Roger, so you're like way above most of us. So how are we going to help these people figure out what these things are, what they can buy, how can they be comfortable? I think that's really the number one thing here. If we want people to engage in this asset class, they need to know what they're engaging with, and clarity on those rules is what's at stake.
Got it. Aaron, what's at stake?
Maybe to look at this from the lens of a company, I think there was a time when some companies were a little bit hesitant to dip their toe and jump into the asset class, whether that was due to the regulatory framework or lack thereof or accounting guidance. What we're seeing is a shifting of the tide where now businesses are saying, the business opportunity out there is so significant, I can't sit on the sidelines anymore. So what's at stake from a business perspective is that you ultimately fall behind in a competitive landscape, that your competitors are offering things that you're not offering, and so you're falling behind. And that puts a lot of pressure for companies to make sure that they're prepared for the middle and back office requirements to support the infrastructure and the scalability of those solutions and programs and business opportunities to grow and scale. And what's at stake there is, you have a misstep with an auditor, or you have a misstep with your regulatory body. So I think it's very important that companies are thoughtful in what are the economic opportunities available to us as an organization to lead out in our industry, to be the standard in our industry. And then how do we prepare ourselves from a middle and back office perspective so that we can be that industry leader without having any foot faults on the regulatory frameworks that we're required to play under, whether that's the tax side, whether that's the accounting side, because the consequences of those foot faults can be severe. So I think there's a lot at stake for businesses as they operate in an ever-evolving and ever-competitive landscape, and then staying within regulatory compliance as they do that.
Makes perfect sense. Fred, what's at stake for not engaging with people like you?
Well, look, the U.S. capital markets are the most robust and largest in the globe. And what we're talking about here is basically the plumbing for the capital markets. From an accounting standpoint, it's critically important that the accounting reflects the economics. That's our goal, is to make the accounting reflect the economics, and that's the best interest of the investor, and that's in the best interest of an efficient capital market. So engaging with us to make sure that we can understand the economics of the transactions and we can reflect those back into the accounting standards, so that is the best accounting standards we can have for investors, is really what underscores the capital markets in the U.S., and especially with an emerging asset class like this, engaging with us can really help us do that. And we have a robust process, a lot of outreach, and please reach out to us.
It's fantastic. And I would say, from our perspective, our company motto is building trust in blockchain. It's neither left nor right, or what is the economic promise? And it is about financial empowerment. It is about embracing the economic promise. And many of us lived in a world of pre-internet, where if you would say, I can go shopping without leaving home, you'd be nuts, because you had to go to a store to go grocery shopping. Now, clearly you don't. So it's all of these kinds of things to export dollars, being with the financial innovator, of, quite frankly, one of the ones of the globe. I think it's essential. So, and to us, in fact, that's part of what's at stake, not being or losing our place amongst the leading financial innovation companies of the world. So thank you. We're out of time. We thank you for sharing the last 49 minutes. And so we don't make it 50, we'll walk away. Thank you.